China cut key lending rates again on Monday, 1 week after it cut two interest rates in a surprise move. The People's Bank of China has trimmed its 5-year loan prime rate, which is used as a reference for mortgages, to 4.3%. And it cut its 1-year LPR by 5 basis points to 3.65%. Last week, the Chinese central bank lowered borrowing rates for some lenders in a bid to boost demand for credit as COVID-19 lockdowns and debt concerns in the property sector weigh on the Chinese economy. Well, earlier I spoke with Helena Huang, China economist at ICBC Standard Bank in London. I asked her how much propping up the markets needed right now.
I think this is, in one sense, it's well within market expectation following last week's 10 bips of MLF cut. But at the same time, the 15 bips cut in the 5-year LPR rate is still slightly beyond market expectation, as it will help to revive the sentiment, particularly with regards to the housing sector. This essentially is going to be very positive to sort of cheer up or revive a bit of the home buyer sentiment, as they will be able to benefit slightly cheaper borrowing costs going forward if they want to apply for a mortgage. But overall speaking, I think when it comes to the broader economy, much more probably is still needed from the PBOC or the broader set of monetary and fiscal policy setting.
And you mentioned mortgages there, and the property sector has had a range of issues recently. Which sectors are most affected at the moment?
The housing sector is still clearly the most vulnerable sector for the time being, as it has already saw a very substantial decline in terms of both sales as well as investment sentiment in the first half of the year. And we are yet to see any signs of bottoming up within this sector in particular. Elsewhere, clearly, all these other consumption or hospitality-related sectors are also affected because of the zero-COVID policy, because of these restrictions. And that's much to do with how Beijing's prepared to go forward with their response in terms of the pandemic control.
And the world's second largest economy taking a different approach when it comes to policy compared to the likes of many developed nations who are looking at interest rates, for example, to tackle inflation. Why is it taking a different approach?
I think most fundamentally the PBOC needs to make its policies based on what the fundamental is playing out in China. And for China, as we've seen in the first half of this year, it's still in this very bumpy road of recovery from the lockdown in April per se. And because of the zero-COVID policy is still very well in place, I think that from the central bank's point of view, it's still the time or the cycle for us to adopt the easing policies so as to provide support to the real economies in particular. So I wouldn't expect the PBOC to easing stance for now. We are probably still at the beginning of more easing to come through from the monetary policy front. And that's very unlike of the other nations where we are seeing the rate hikes. And the other thing is, particularly in terms of the inflation, within China, that's more of a job for the NDRC to take care of the inflationary pressure. And we've already seen very positive results on the back of that. So for the PBOC, it has less burden, less inflationary burden to to concern about. And therefore, it has greater flexibilities to continue its easing policies going forward.